Welcome to the Real News Network. I'm Paul Jay in Washington. In Paris on December 9th, the European leaders will meet to try to save the Eurozone. We are told if there's not a deal, we could see the unraveling of the euro, perhaps even fractures of the European Union, and perhaps this will trigger a deeper global recession. We're told these times are momentous. So now joining us to try to unpack all of this is Matias Vernengo. He's an associate professor of economics at the University of Utah, and he joins us now from Salt Lake City. Thanks for joining us, Matias.
Oh, thank you for having me.
Okay, so Matias, what's at stake in these meetings?
This is the nth round of meetings that suggest that we're really slowly slouching towards an agreement by the Germans to foot the bill, if you want, for sustaining the euro. This has been done, in a way that it seems to me it's still far short of what is needed. So it's based on moving in the direction of fiscal union, and it's based on the notion that fiscal austerity should remain in place. And pretty much he's still remaining with an unwillingness of the ECB to buy bonds of peripheral countries, which is, at the end of the day, that's the simple solution for this problem.
Well, is the point of this fiscal union that Germany and to some extent France, but they're saying that the European Central Bank, we'll buy some of the bonds of Italy and Greece and Spain, and we'll shore up this bond market. But in exchange, the Germans are saying, and I guess the French are saying, they want to impose this fiscal union. Does that just mean they want to be able to essentially bypass national politics that might oppose this austerity policy and create this kind of unified fiscal policy that it really won't matter what the peoples of each country want?
Fundamentally, has been happening already. So if you look at at what happened in Greece, it's very difficult not to say that already happened. So when you look at Papandreou, he fundamentally said, I'm going to do a referendum, and the referendum eventually was eliminated, and he was sacked, and so from that point of view, we already have and several of the other governments. So in Spain, you have that the Conservatives have won. In Italy, that not that I'm particularly favorable to the ex-prime minister, but they also brought Monti to do the adjustment, the fiscal adjustment. So the rules of fiscal austerity have been already in place. They precede this. In all fairness, the Growth and Stability Pact was in place since Maastricht, fundamentally imposed rules of austerity that were valid when it hit the periphery, but not when it was with Germany. So and even the participation of the IMF for people like myself, that I'm from Latin America, it seems like deja vu. The IMF has been in place over the decades, exactly there to guarantee that fiscal austerity and and hence the shrinking of the economy and extraction, if you want, of surplus from the people in order to be able to pay this it takes priority. In the case of Europe, as much as in many Latin American cases in the past, you have to understand that this was not an over expanded state that was expanded. It was a private boom led fundamentally by financial liberalization that has been bailed out by the state. And so now, the people that did not benefit from that particular boom are being squeezed, in order to repay financial markets. So this also has, obviously, for people in America, in the United States, incredible resemblance with what happened over here with the housing bubble and the fallout of the.
So what's the fiscal union do except maybe make it easier in the future to impose these kinds of policies without having to go through bringing down governments and changing prime ministers? I mean, how does the fiscal union do any more than that? And is that going to reassure, quote unquote, reassure the bond market?
What probably this does is that it creates the political conditions in which the Germans can sell this to the German population, saying, look, now there are general rules within the European Union that guarantee that people in the periphery will have to pay with taxes, and you're not going to be overburdened So it makes it politically acceptable to fundamentally guarantee those bonds to the German and I suppose to a lesser extent the French people. So I don't think in other terms it makes any other significant change. The way that this would be truly different is if the fiscal union implied that there'll be, rather than austerity, significant transfers of funds towards the periphery countries, which is perfectly feasible and should be done. And in the U.S., with all the political difficulties, it's being done. So I always say, if you imagine, if you take a loan in Salt Lake City, or if you take a loan in Washington D.C. to buy a house, the interest rate is fundamentally the same. If you look at municipal bonds in the U.S., they're fundamentally the same whether you're in California, a state with fiscal problems, or whether you are in New York. So French bonds, let alone Italian and Greek bonds, are paying a significant premium over German bonds, and so this can be done without the austerity rules. So the important thing here is I think to ask is who benefits from these austerity rules and who loses from these austerity rules. And part of it's not just that banks are going to benefit from these austerity rules, but corporations in general in Europe benefit. The fact that workers in Greece and in Italy, are doing incredibly badly because of levels of unemployment and the deflation of assets. The fact that they are in that situation also helps to keep German workers in line, and so the benefits are general, not just for the German banks and corporations, but for the elites in the peripheral countries. So in many respects, this it's less, if you want, a question of countries and more a question of an old question of capital and labor. It's capital in Europe is doing pretty well, but labor overall in Europe is doing incredibly poorly.
Now, if they do have these new rules, one of which, interesting enough, is that if there is any future restructuring of sovereign debt, like recently took place in Greece, one of the new rules is going to be private bondholders won't be asked to take a haircut. It will only be the governments, in other words, taxpayers of Europe, that take the loss in one country or another, but they're going to protect private bondholders. But anyway, all that being said, all bondholders really seem to care about right now is that they're sure they're going to get repaid, and they probably like higher and higher interest rates, but they don't really care what happens to the real economy. So even if they make the best case scenario deal in the eyes of bondholders, what are we likely to see as a result of that?
Part of the story here is that people don't understand is this crisis has been functional. It serves certain interests. So the fact that the real economy does not completely recover has not been necessarily a bad thing for bankers and for bondholders in Europe. So from this sort of continuous meetings in which we're threatened with the notion that if we don't do what financial markets want, we're going to go into a spiraling crisis in which everything is going to get worse. Is being used to benefit these groups, and we're kept always with labor markets that are slack and high levels of unemployment. It's very much the same that is happening in the U.S. We have a recovery, the levels of unemployment remain high, but we always say that if something happens, we need to go and rescue financial markets. So there is a functionality in this crisis, and keeping things on the verge of the crisis is exactly something that works for them. So I don't expect much from this, and it's starting to look, although there are obvious differences between Greece and other countries in the periphery. Say, for example, Argentina is often used as and Argentina did default, Argentina did devalue, so it would be the equivalent of getting out of the euro with respect to the dollar in the case of Argentina. And Argentina did grow a lot. That's not necessarily the case in Greece, because Greece depends way more on exports to Germany than to say China. But it's still starting to look like there's very little for the people in the periphery and even in the central countries countries to win from this European project. The other thing is that people used to talk about the European project as if this European project is the same European project of the 50s, a project that was trying to create, a political union in which the so-called German problem sort of vanished. This has very little to do with that. This current project is a project that raised throughout the 80s and 90s, and it's a neoliberal project that it's based on of financial interests. So I wouldn't expect much from these talks.
So the one thing that's probably for sure out of all this, both in Europe and in the United States and Canada and these countries, that wages aren't going up. Wages are probably going to remain either stagnant or even go down, which I think is the trend in the United States, which means demand is not going to grow, which means where are we after all of this?
Exactly. And then you go to a point that it's essential. You see, the fulcrum, the beginning of this, in the US and in Europe has to do with the fact that over a very long period, in the case of the US going back 30 years, in the case of Europe going back to something less, but something not far from that too, of wage stagnation. So these financial bubbles, what they have allowed is an exchange, if you want, from higher wages. It used to be that people spend money on the basis of better jobs and higher levels of wages and access to education, cheap public education, and higher living standards in the future. That has changed. So over the last 30 years, what you have is private debt. And so it's very different even if you look at what's happening in the periphery. So China, it's growing now increasingly on the basis of its domestic market and on expanding wages. That's certainly not the case in Europe and in the US. So what we have had is fundamentally wage stagnation, and that would be the long-term solution for this crisis.
Thanks very much for joining us.
Thank you for having me.
Thank you for joining us on the Real News Network.